Hi traders, welcome to another edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a look at the disclaimers, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. For this webinar, we'll follow the standard format really. So we'll check out how markets are shaping up currently. We'll then look at the rising 10-year US Treasury yield, which has been a key focus for markets and a key driver for markets over the last few weeks. We'll just touch upon a couple of charts and how that is looking at the moment. Something not everybody looks at all the time, but for sure at the moment this is a key theme driving markets, as I say. We'll then look at stocks. So we'll look at Nvidia's upcoming earnings report, which is out after the closing bell in the US tonight. We'll then check out some of the charts as well, so the S&P 500, the Dow and the Nasdaq 100, and check out the technicals around those major indices. We'll then briefly touch upon some of the data that we've seen over, well, today actually, and also over the last few days, the last week actually, in the US, and also some of that major UK data we saw last week. Before then wrapping up really with a focus on the Fed's annual Jackson Hole Economic Symposium, and also Fed Chair Powell's speech on Friday morning, that is UK time, so Friday Eastern time. It's UK afternoon time, 10 a.m. Eastern time in the US. Okay, first of all, markets at the moment really sort of largely in a holding pattern at the moment after an extension of the rally yesterday ahead of the US market open was erased actually during the trading session, while risk sentiment in Asia brightened. The dollar has broken to new highs this morning after softer than expected PMI data out of the Europe and the UK, and we'll look at that in some detail in a few moments time. US stock futures in the green still, erasing actually all the gains from all the losses from yesterday. So in the green at the moment, US stock futures, while gold is currently trading just above 1900, but probably below 1902 gold is at the moment, below the 200-day moving average, which is around 1907. All eyes, as I've mentioned, will be on chip giant Nvidia's earnings report after the market closed today. As it's meteoric rise on AI-linked mania really requires really stellar numbers, and guidance is key to support the share price and really then to support some of these gains that we've seen certainly in the Nasdaq and the S&P 500 over the last few months, well, over the last first half of this year, although we've seen some of that given back, of course, in the last month or so. Of course, markets then hotly anticipating Fed Chair Powell's speech at Jackson Hole, as I've mentioned. That will bring potentially longer-term policy hints around the Fed and policy action going forward into the end of the year, or certainly from September, November, when it has the FOMC meetings. Of course, this all comes at a time when those US 10-year Treasury yields, so that is basically a global proxy for borrowing costs, they hit 16-year highs above 4.33%, and already supported by persistently upbeat macro data, which actually one of the Fed officials last night, Richmond's Fed's Barkin, described as impressive in his comments yesterday. So really the major theme at the moment is rates are going higher and staying higher for longer. There's kind of been a confluence of factors around that. So we've had major Treasury issuance, supply coming on board. We obviously had that recent US debt downgrade. And then we had the Bank of Japan's surprise relaxation of its yield curve control policy. All sort of tallied then with this better than expected data, really upward revisions now to US growth forecasts that we're seeing. And that has really pushed these yields much higher than most were expecting over the last few weeks, certainly. This is a long-term chart that we like because you can just see a very long-term chart actually of this US 10-year Treasury yield, and you can see that falling trend line from way back in the 1980s, you can see, and we haven't really broken above it. We've touched it, and the times when we have touched it has been when we've had sort of crises in the financial markets, and then up until certainly the last few months where we've broken sharply above it, and we're up to sort of above 4% now in this US 10-year Treasury yield, potentially then sort of precipitating another crisis. But of course, many strategists have been saying this, and that we'll get this slowdown, but then the US economy keeps on surprising generally to the upside, even if sort of employment data is strong but slowing as well, and in amongst, of course, the most aggressive policy tightening that we've seen in decades. I just want to show you one of the charts actually. So this 10-year Treasury chart at the moment, just near term. Just bear with me 1 second while I get that chart up. Which is here, of course, and just to point out, so you can see sort of 3.5%, just below really 3.32%. I've got it there as a support line. But just this idea that Treasury yields have moved sharply higher up to this sort of now 4.33%. That's a massive move in bond markets. But we are now very close to these October highs. Well, they were at 4.33%. Yesterday we tapped that at 4.36%, but now we've moved lower down to 4.26%. So just interesting, we've tapped it a couple of times over the last couple of weeks, that level 4.33 in the 10-year, and failed to move above it. So interesting resistance there. You can see that on the daily. I've got the big dotted line here, which is 4%, was sort of key psychological level. But 4.33% is an area which everyone is watching those previous highs, and whether that acts as resistance, which it is doing at the moment. Of course, we have Chair Powell's speech on Friday. We'll go through that, but really interesting that we're bumping up against this key resistance level now. I think just a couple of things on this sort of 10-year Treasury theme. The latest uptick really doesn't reflect significantly higher implied probability of the Fed delivering another rate hike, but really it's longer dated real yields. So those are nominal yields taking away inflation. They're rising further, and that could imply then that markets are turning increasingly bullish on the US economy, not just in the near term, but also for the coming years. Potentially that has an impact on Fed policy. There are rumors that possibly the Fed will announce something in September about that. We'll get onto that shortly. But intriguingly as well, let's just remember the 10-year yield correlates most with the pricing of the policy rate 4 or 5 years forward. So in other words, a Treasury sell-off that we've seen, remember, prices go down, yields go up, is less about the sort of terminal rate for this cycle and more about Fed funds rates settling under more normal conditions. So really interesting, couple of ideas there, a couple of thoughts to just bear in mind when looking at this yield and then guiding us for markets going forward. Okay, let's move on to stocks then, and Nvidia's upcoming earnings report for sure. I'm going to pull up the chart actually in Nvidia, if I can find it, first of all, which is there. That's actually a daily chart, so you can see just move lower off those recent highs, those long-term highs, which you can see there on the weekly. After the close then, results coming out, really pivotal moment for markets, essentially because of, well, particularly for the cluster of AI-related stocks that have experienced really substantial gains throughout this year. Analysts anticipating revenue to reach 11 billion. That's kind of a figure in your head you can keep, marking really a remarkable 65% year-over-year increase. And then EBITDA, that's earnings before interest, tax, depreciation, amortization, they stand at 6.3 billion, so a massive jump from 924 million reported a year ago. The surge obviously attributed to the skyrocketing demand for AI research and implementation, which has then really followed after that successful launch of OpenAI's Chat GPT. It's worth noting that the driving forces as well behind some of this demand surge for chips are coming from Chinese technology companies. That trend really gained prominence due to China's recognition of its lag in the AI sector, and then also fearing potential future export restrictions imposed by the Biden administration. So Chinese tech firms really amassing these modified GPUs from Nvidia, and this kind of proactive measure is kind of an attempt as well, longer term, to secure a stable supply of crucial components for their longer term AI endeavors. Central question really around Nvidia really is whether it can sustain its fiscal year outlook. So guidance will be key. This pivotal moment really will unveil whether this initial rush of demand remains consistent or if there are signs of cooling. The market will be closely observing these results really to gauge the trajectory of AI-related sectors and then the extent of Nvidia's influence within this landscape. So really interesting. You've got as well, we did make a new high there on the stock at 481.87, just beating sort of 478.96, and just below that 480.88. Sorry, just above that, yeah, 480.88. Those were in July. Those are July highs. Then we had a sell-off, and then we pushed up, as I said yesterday, to a new high. Really interesting just before the results. I'd probably say, yeah, yeah, tough to call really. I guess you go to round numbers if we do break higher, so 500, 520 being the obvious sort of round numbers possibly. But before that, I guess, yeah, we need to break the high earlier made today, which is at 481, as I said, 481.87. Otherwise, support could come around that 50-day moving average, 437.85, probably initial support, and then possibly these levels lower, 416, and then below that sort of 400 around there as strong support for the stock. So that's Nvidia. As for the indices in general, just bear with me 1 second. Well, let's remember last week global stocks had actually the biggest weekly drop since March, so investors really grappling with this prospect of higher rates for longer, as I've mentioned, and then also those developments and soft data that we saw out of China really continue to stir concerns about China's post-pandemic recovery for sure, and we've seen that obviously this week with the PBOC cutting rates, but also then not cutting one of the loan rates, the mortgage rates, which was a slight surprise and a disappointment to many as well. The S&P 500, so that fell 2.1% on the week, so it's third consecutive week of falls. And the tech-heavy Nasdaq, that fell 2.6% over the previous 5 sessions, Monday to Friday last week. I think it's interesting, the Magnificent Seven, remember those mega cap tech stocks, so that's Alphabet. Let's remind ourselves, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. That's 7, I think. They lost actually more than 900 billion in value over the previous 3 consecutive weeks of falls, and that was their worst run of combined market decline this year. So yeah, just sort of big numbers on these on this sort of tech fallout as rates are higher for longer, and really sort of growth tech stocks take a dislike to higher bond yields for sure. Just on the technicals then, we can see that really nice bullish channel for most of this year, or certainly from sort of late February, early March, series of higher highs, higher lows, and we've just broken out now down to the downside in that out of that channel. So it will be interesting on a sort of weekly basis whether we close possibly below that 43.35 level. And then we've got a big fib level in there at 43.11 as well, just below that as support. If we just go to the daily, we can see that as well, that breakout of this long-term, really ascending channel, bullish channel. You've got the 50-day moving average now at 44.56, and then below that, tallying with that 43.11 fib level, you've got 43.04, which is the 100-day moving average. Key level there of support. To the downside on the Nasdaq 100, similar breakdown through that ascending big bull channel there that you can see. We've got a minor fib level at 14.696 as support, and then last week's low at 14.557. That's initial support before then a bigger, well, it's a more medium term actually a fib level that I've got in there just below 14,000. That's Nasdaq 100. Also interesting, I think, the Dow, because you've got this 34,281 level of resistance, now support potentially. We're just very close to that, so that had capped the upside. We've been talking about that over the last few months. We saw a push up towards the swing high at 35,492. We couldn't quite close above it, you can see on the week, and then we've fallen down back towards that big level at 34,281. So really interesting whether that now holds prices, and much will depend, of course, on Powell, and if he is less hawkish than many think, then possibly that will help stocks, and we will see a bounce off this big level in the Dow. Okay, let's move on now to well, US retail sales last week. They showed, just touching on data from last week really, US retail sales showed surprise strength. They rose 0.7%, accelerating from an upwardly revised 0.3%, above expectations 0.4%. We also had other beats in the X autos measure and also the Supercore X gas and autos, and then also the control metric that feeds directly into GDP numbers. That was hot, rising 1% against expected and prior 0.5%. This all has fed into one of the metrics that many people look at. That's the Atlanta Fed GDP now estimate, and that's revised up now, being revised up to 5% now for Q3 from 4.1%. So strong data, still strong data. The US consumer still has some of those savings from sort of lockdown period, and keeping retail sales pretty strong there, and surprisingly so. FOMC minutes, that was out last Wednesday, minutes to the policy meeting from July, when the Fed raised rates by 25 basis points to 5.25 to 5.5%. That really showed, the minutes showed officials continue to have a bias to hike further, much as they outlined in their forecast update in June, when they penciled in the July hike plus one more, let's not forget, before year end. There wasn't really any specific guidance surrounding the September meeting, but that will be down, of course, to incoming information, incoming data, and the base case now is, well, they removed a mild recession as their base case, and really now it's real GDP growth. They're seeing in 2024, 2025 would run below their estimate of potential output growth, leading to a small increase, only a small increase in the unemployment rate relative to its current level. So in a way, they really are threading the needle here towards this very soft landing, which historically has been exceptionally tough to do by policymakers, and we normally expect a policy error or certainly a recession and slowdown due to this most aggressive policy tightening cycle we've seen, as we said, in sort of living memory, really. Okay, since that decision, of course, we've had a second 0.2% month-on-month core CPI print. Encouraging news on moderating labor costs, more modest job creation, but then we've seen ongoing strength in activity data. Key question then is whether they carry through with that final forecast hike. Certainly the combination of higher borrowing costs, we've talked about those, and less credit availability, plus the pandemic era savings being run down, as I've said, but eventually run down. Potentially that puts a sort of squeeze in the fourth quarter and beyond, which would then mean consumer spending activity moderates. At the moment, we're not seeing that, and we're seeing this theme around higher rates for longer because of these upward revisions to growth forecasts. I was going to bring in actually just the Fed Watch tool, which we use a lot of. Hopefully you guys have used it as well, but I just want to point out this matrix really here, not there, sorry. Just bear with me 1 second. Just bear with me 1 second. I'm just trying to show you something. Yeah, before I get to that, yeah, so we can see just looking at what the market is expecting for the next few Fed meetings. I've kind of mentioned that not much has changed for the September meeting, so no changes expected, but it's just further out where we see the chances of a rate hike have increased. Slightly lower than yesterday, but yesterday we were up to 41% chance of a 25 basis point hike, 45% chance if you include that, going higher again. So sort of nearly a coin toss chance. That's come down slightly to around 40%, say today, but that sort of compares with, say, 27% a month ago. The key thing, though, as I said, is really that interest rate cuts are no longer expected to begin now until June 2024. Whereas, and you can see it here, sort of June 2024 or so, maybe May, so slightly brought forward. But 3 months ago, markets were expecting up to 4 rate cuts into 2023 alone. So that's how you can see this major difference as pricing in the markets, which will be interesting to see if Powell addresses. Okay, let's get to now just UK data quickly, and just bear with me 1 second. I'll just bring up a couple of charts which show us some of the key bits of data that we saw last week out of the UK. Firstly, well, just before we get to the CPI numbers, we did have jobs data the day before the CPI numbers, and labour data for July saw, well, modest signs of cooling actually, but then wage pressures continue to complicate the inflation trajectory. So we had unemployment rate that ticked up to 4.2% from 4% previously. So that sort of modest signs of cooling, but then the biggest shock was the average weekly earnings, which came in at 8.2% for the month, 3 months of June, from 7.2% previously and 7.4% expected. So real big highs, a big shock there, and a September pause from the Bank of England now looks very unlikely, and since then, of course, more than a 25 basis point rate hike after those numbers was priced in by markets. Wage growth really remains too strong for the MPC to end its rate hiking cycle at all, and it's really about this potential follow through to inflation that policymakers are worried about. As for CPI data, the following day that came in hotter than expected. Headline 6.8%, So falling from the 7.9%, but was higher than the expected 6.7%. That's key. Also, core CPI that was unchanged from the June level, so it's 6.9% versus 6.8% expected. That larger step just in the headline was due to falling energy prices because of the resetting of the Ofgem price cap. That essentially meant a 20% lowering of household bills for consumers, which I think economists reckon alone dragged headline inflation lower by 0.7% on the month. And we know actually there is another reset in October, so that will bring down the headline lower. That's all good and well, but certainly policymakers are focused on the hot core prints and certainly as well then services inflation, and that picked up again to 7.4% from 7.2%, so that's higher than the bank's forecast and actually the highest since 1992. So services inflation, core inflation is key for the Bank of England, and certainly couple them with those hot wage numbers that we saw. That kind of has cemented now a 25 basis point September hike, fully baked in. And we did actually have, after those CPI numbers, around a 25% probability of a larger 50 basis point move. We note actually we do get another set of both price and wage data before the Bank of England September meeting, and then another round of numbers before their November meeting. But certainly it's really the focus on this slow progress about inflation and wage growth, and that's really seen the peak rate now push up. Well, it had pushed up to near 6%, which meant sort of another 75 basis points, 70 basis points of rate hikes by February next year. I should add, however, before we get to that, you can see just a couple of charts. You can see the dark blue line is the headline inflation rate, which is certainly falling nicely, but it's this sticky services, sticky core numbers, which are concerning the Bank of England for sure. Wage growth as well, you can see, I said hit 8.2%. Actually a record high outside this distortion from the pandemic. So again, much hotter than policymakers would like. I should add, of course, today we have seen PMI data out of the UK and the Eurozone already. Just bear with me 1 second. I just want to pull up the cable chart first of all, which is here. Let me just check you're seeing that, which you are now, so that's good. That's a weekly chart, but just before I get to that, yeah, those PMI numbers earlier this morning, really weak and very disappointing, really. Manufacturing 42.5 versus 45 expected, and the prior 45.3. But it was services really, which all eyes are on at the moment across PMIs. Really in the Eurozone, UK and probably the US as well. They've been holding above that 50 boom bust line, contraction and expansion territory, and sadly they followed the lead of manufacturing now, and in the UK printed at 48.7 versus 51.0 expected and 51.5 the prior number. That all left the composite at 47.9. So in contractionary territory. That was against 50.4 expected and 50.8 previously seen. So that has now lowered the pricing for the Bank of England meeting. September still priced in, but further out, the peak rate now is seen below, actually well below 6%, closer to 5.8%, which means then two and a bit extra rate hikes now. So a major repricing since that PMI data. It will be interesting just thinking about the Bank of England, actually, just to note, of course, PMI data, PMI surveys are forward-looking data as opposed to what the Bank of England has been looking at, which is inflation and wages. These are lagging indicators. So just it'd be interesting to see how much attention the Bank of England do pay to these forward-looking indicators, which show that the rate hike the rate hikes that we have seen are now impacting services, which is crucial and potentially important for wage growth further out, and whether that slowly comes down as we're seeing these PMIs in the services hit or go into contractionary territory. Just on cable then, we can see on the daily, you can see that big move lower then after the data. If I go to here, you can see when was the data? Well, we were moving lower anyway because of the dollar, but then after the data, we sort of moved from sort of mid 127s down to low 126s. Just on the daily then, you can see now we're tapping into support at 126.30. That's this fib level here, and then also the 100-day moving average, which tapped, acted as support previously. You can see that's a 126.35, so we're just below that now currently. So first line of support really around here, then probably we get to the June lows at 125.91, so just below here before really the next fib level is around sort of 124.70 or so. So not a lot of support after this sort of 125.91 level in cable. Okay, we'll just touch upon now quickly Eurozone data and what's been happening in Europe. We had again the flash PMI data out today. Again, should highlight, it's good to highlight, this is forward-looking economic indicators, and they are conversely quite important for the euro and the ECB. Of course, the bank is officially focused on inflation, but evidence of slowdown in key parts of the euro area has been mounting, and potentially now with this data is probably too blatant to be overlooked. Certainly though, this data also gives us information around inflation and prices, but the data, manufacturing, that jumped actually to 43.7 from 42.7 in July and 42.7 expected. But again, services was in focus. That declined below 50 to 48.3 from 50.9 previously, and below the expected 50.5. That left the composite down at 47.0 against the previous 48.6 and the expected 48.5. So really more weakness confirms a sluggish economy with recession as a downside risk. And then as for prices, then inflationary pressures are showing up still in services, in the services sector. They remain stubborn as wage pressures continue to be a concern. Of this, the manufacturing sector has been in contraction for some time. New orders have been falling and the backlogs of work have been easing. But as I've said, it's around this services sector data that has held up for a while, but is now showing signs of contraction. But then we also have, although goods inflation is easing back on lower costs and weak demand, it's services inflation which remains an issue for the ECB. Potentially, the hawks may well jump on it as increased wage cost pressures still are evident despite that weakening demand, and that potentially puts the hawks in place to push for another hike at the September ECB meeting, which may well be their last chance to push for that hike before then we see this downturn spreading through the economy. From the policy perspective for that September rate hike, prices, that was priced around a 63% chance before the numbers, is now down to around 40% chance of a 25 basis point hike at its September meeting. Let's note, we do get a flash Eurozone CPI data on the last day of August that will probably cement calls over what to expect next month. The euro, though, you can see has been hit today. It's sort of downtrend from that high in mid-July at 112.75. We sort of held up around a couple of these long-term moving averages. That's the 50-day moving average, 109.79, and then the 100-day moving average at 109.28. Sort of did hold up prices, but then now we've moved lower below those, tapped it a couple of times, so that now acts as pretty strong resistance. 109.28 it is, that 100-day moving average, and we're moving slowly towards that. The black line now is a 200-day moving average of 107.97. We don't have any fib levels in here apart from long-term fib levels. So interesting whether the 200-day will act as some sort of support. It hasn't really been of note, you can see, in euro dollar. So really then we're looking at fib levels and then potentially round numbers below 108 down to sort of the 107 region, where these May lows and June, early June lows came before then moving higher again. I think interesting, I have mentioned, well, I have looked at this before, I think, but just we've had 3 corrections so far in euro dollar. Previous ones have been around 5%, 4% or so, and now we're closing in on a 4%, actually, yeah, just over 4% now, I think, correction in euro dollar. A lot of that has been brought on by positioning, which has been short. Long and positioning, because the consensus estimate for the year-end euro dollar rate is around 112. So just keep that in mind, although certainly this PMI data, keep that in mind, because the PMI data does lessen the chances of a hike, which were sort of nailed on before, well, only a few weeks ago actually now, and that's why we're seeing selling pressure in the euro dollar, which yeah, could hold up around the 200-day moving average around 108, but yes, not looking that positive in euro dollar. Okay, let's now move finally to the Jackson Hole Fed Chair speech. If you just bear with me 1 second. Just pull up a chart here, which is obviously inflation in the US, which you can see headline fallen sharply from sort of above 9% down to 3.2%, but core still quite elevated at 4.7%, remembering that the target for the Fed is 2%. So yeah, markets gearing up really for this annual Jackson Hole Economic Symposium, where really investors are hoping the renowned get-together will give some clarity on the Fed's intentions in the months ahead, really amid an economy, as we've said, enjoying falling inflation, still sticky core, but resilient activity. The theme for this symposium is structural shifts in the global economy. It kicks off tomorrow, but then, as I said, Chair Powell's keynote speech is scheduled on Friday at 10 a.m. Eastern time. The event is kind of historically been seen as a platform for Fed officials to signal policy intentions and potential changes in the medium term. And in fact, some market watchers do regard the conference as an unofficial policy meeting. And if we think back to recent previous Powell speeches, well, they've included actually the now infamous suggestion that price pressures evident in the US economy would be transitory. If you remember that, that was 2 years ago, and proved obviously somewhat incorrect, as inflation, of course, across the globe hit multi-decade highs. Last year then, Powell used the venue really to declare that the Fed would continue raising interest rates with urgency to fight rampant inflation, of course, and he was really trying to send the message that the tightening cycle was just beginning. So we saw a powerful rally in US yields, and that really turbocharged the dollar and slammed stocks. Of course, the landscape is very different today. Inflation, we can see on the chart, has moderated, although much of this improvement is because of the declines in energy prices. Core, as we've said, is still running hot. And since the labour market remains extremely tight, the unemployment rate stuck near 50-year lows, there are concerns inflation might not return to its 2% target anytime soon, especially with this recent activity data proving better than expected. From recent commentary then, it appears Powell will keep flexibility to hike rates further, while clearly avoiding committing to rate cuts anytime soon. Of course, it seems too early though for the Fed to sound the all clear on inflation, but the current data dependent stance adopted by the FOMC could prove quite challenging, really, because growth is well above trend, which should ordinarily mean markets have priced in another rate hike. But as I showed you, there's kind of little chance of that happening in September. Current odds for November around that sort of 36-40% mark, so less than a 50-50 bet still for another rate hike. Well, consensus then, always worth talking about that, really sees the Fed wanting to, Powell, leaning hawkish, and this emphasis around rates staying higher for longer. Of course, some at the Fed do want to wrap up the rate hike part of the cycle, but then it, of course, doesn't want to flip-flop, if you like, saying it's done and its work is done and on hold for a long time, only then to have to raise rates later on in the year. Yes, as I say, then consensus leaning hawkish and emphasis on higher rates for longer. We do get important data releases in the next few weeks, including fresh inflation and, of course, non-farm payrolls figures. So really, if we do get that, really then the dollar probably holds on to its recent gains. And if we just pull up the, we'll just pull up the DXY chart just to quickly have a look at. It's kind of the inverse of the euro dollar chart, because the euro is obviously heavily weighted in this index, around 56-57%, and you can see, as opposed to corrections, then we're getting dips in the DXY, but then this nice strong rebound, as I said, around 4% or so now. So on the weekly chart, you can see the 50-week moving average just above here, 104.63, and then we've also got these May highs around 104.69. So that should offer some resistance potentially. We did think these highs from June, July around 103, sort of 57, 103, 54, they would hold prices, and they have done, but now we've pushed higher on those softer than expected PMIs out of the UK and Europe. You can see the 200-day moving average, that's now offering some support. That's at 103.15 below, but now if we do break higher above these previous June, July highs, then as I said, we're getting up towards sort of 104 round numbers, and then up to this sort of noise above 104, around 104.50 and just below that high from May, as I said, 104.69. That's in the DXY. Okay, we will wrap it up there. Just bear with me 1 second. Yeah, we'll wrap it up there. Hopefully that's proved of use to you guys. It's great to have you on a call, and we'll speak to you in a couple of weeks.